the loan officer training series with the mortgage calculator. We'll get started here in just a moment. Just wait for us to go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So give us a second to get up and running on all the different platforms. And in the meantime, please drop a comment as you tune in. I see some people who are already tuning in early, dropping comments there for us. Julio, Dea, Owen, Benedict, Dario, Crescita, Oscar, Raul, thank you for the comments. Anybody else, when you first tune in, feel free to drop a comment there. We did put the comments up on the screen. We're just going to wait a few minutes here to go live on all the different platforms. Great topic here for tonight, continuing off of yesterday's topic. And we'll get into it here momentarily. But feel free to drop a comment there as you tune in. All right, Roger, thank you for the comment. Appreciate it. All right, it looks like we are live on all the different platforms, so we can go ahead and get it started here. We'll take the chat off the screen, but feel free to keep dropping comments as you tune in and drop any questions you have there in the chat as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender specializing in non-QM loans. And what we do every Tuesday and Wednesday night at 7 p.m. Eastern is this loan officer training, where each week we pick a different topic and do a training on it. Now, this week's topic is renovation loans. We talked a little bit about them yesterday. So if you haven't seen yesterday's episode, go ahead and look that up. We're going to expand on it tonight. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to pick up where we left off last night and talk about structuring renovation loans tonight. So Jose, why don't you touch real quick on what we mean when we're talking about renovation loans again, and then we can talk about how to structure them.
Good evening or good afternoon, everybody. Thank you for joining us for part 2 of working and structuring your renovation loans. Now, first, I want to be clear what exactly is a renovation loan, because it could be misconstrued. And you may think that we're talking about a fix and flip loan or a fix and hold loan, right? Those loans are exclusively for investment properties. Those loans do not use the personal income of the borrower. Those loans also close in an entity. And those loans are also short-term bridge loans, where usually anywhere from 12 to 18, maybe 24 months after the inception of the loan, you need to either pay it off or refinance out of that loan. They're basically just a bridge loan to get the project done and then move on. Usually the end product there would be you either sell the property, which is where the phrase fix flip comes from, or you would keep the property as a rental property, which then would be a fix and hold, the more popular one being fix and flip. Now, our product, renovation loan, is for primarily primary or second homes, but for the conventional option, also does allow for investment property ownership. However, on the investment property, they do limit it to a 1-unit property. Second home, they also limit it to a 1-unit property on the conventional now. And primary, they do allow a 1 to 4-unit property. So for our house hackers out there listening, this could be your opportunity to do the ultimate house hack. Just imagine getting that property 2-1, 2-1, 2-1, 2-1, right? 4 2-bedroom, 1 bath, and turning it into 4 3-bedroom, 2-bath properties, because you are allowed to add to the size of to the bedroom count and to the bathroom count. You are allowed to do structural additions with most of these renovation type loans The ones that do not allow any type of structural component would be the limited option, which would be the streamlined 203K or the limited renovation loan for USDA as well. So keep in mind now we're talking about renovation loans and not fixed flip loans. These loans are a great tool for your buyers that maybe are getting a little frustrated with the existing pool of inventory out there. They've seen some properties that they would like to purchase, but maybe they were cash only deals because of property condition related items. Well, this product does allow you to close on these properties that could have property condition related items, be they health related, it's not safe to live in it for whatever reason, vandalism, it's common for foreclosed properties to be vandalized, missing the air conditioning, the electrical system could be stripped out of there. Number of things that could be wrong with the property that would cause it not to be financeable under a standard loan. Well, this is the way to do it.
And we went over all those different types in yesterday's presentation if you missed it. So make sure you check that out, all the different types of additions and types of improvements we can do and not do.
Right. Or those buyers, for example, that got frustrated because they haven't been able to buy, but they own their current property. Well, if they needed more space, the renovation loan, depending which one you pick, would allow them to add that master bedroom and bathroom that they dreamed of, make their kitchen into the kitchen of their dreams, and then not have to sell their property and not have to go on the mission of buying another property. So here, what I'm going to do tonight is I'm going to share some examples, some of these structures. Last night we were talking more in theory, right? Talking about guidelines. Well, here I'm going to give you some real world examples of what your borrower would be facing as far as interest rates, payments for different scenarios on some of their purchases or on some refinance transactions. Keep in mind, real important to note, that conventional loans are split up into Freddie Mac and Fannie Mae. The Freddie Mac Choice Renovation Program and the Fannie Mae HomeStyle Renovation Program. And just like how they differ in how they treat their self-employed borrowers, they also differ in some very important points in how they treat their renovations, right? That's going to be a real important point I'm going to bring up here because, in this market, our borrowers are looking, they're facing an affordability crunch, right? As prices are increasing, interest rates are going up, insurance in most markets is going up. Obviously, taxes are going up because city governments and county governments and state governments have to find ways to increase their revenue because their costs are going up as well. And they're just going to pass it to the consumer, which in this case is us, the taxpayer. So in this case here, I'm going to give you some good ideas on what these consumers can do, our borrowers can do to get ahead of that curve. So in this scenario here, we're looking at a Freddie Mac renovation loan of a primary residence, 95% LTV. $500,000 purchase, and in this case I'm using 740 credit score for the examples. So first you can see the rates, pretty decent rates there, right? If you remember today's rate show in the morning, these rates are not very different than what you're going to get in the standard program that does not have a renovation component. Keep in mind that normally in these renovation type situations, your options would be, if you could even close on the property, right? If it's not a condition related item that would not allow you to close on the property, if you can even close on the property, you're looking at either having to have the savings to complete these renovations, or you're looking at having to finance these through some kind of unsecured loan, which is going to be much higher interest rate than what you're looking at here. Or the worst case scenario, putting them on your credit cards, right? And now all of a sudden, I see that all too often. We see these flippers come to do a refinance on a property. The credit score is a 630. We ask them, what happened, Mr. Flipper? Well, I put all the repairs on the credit card. It was a little bit more than I thought, and I'm a little overextended. And now that's sort of like a domino effect there, because those credit scores start dropping and everybody starts increasing the interest rate on you. So the scenario that's really important to note here in this structure on the Freddie Mac renovation loan, the choice program, is that you are allowed to add an ADU, right? So in our scenario here, our borrower is adding an ADU, an accessory dwelling unit, which could be either attached or detached. That's a very important point to note. Could be attached or detached, because in some of our renovation loan options, anything you do has to be attached to the property. So that's how it is, for example, with the FHA and with the USDA and the VA, they have to be attached. So if you're looking for the ADU, the Freddie Mac option is the one for you. And our borrower is even going to be able to include 6 months of PITI, principal, interest, tax, and insurance, in the new loan. Now, the only catch here, they don't really put a limit per se, like a dollar limit on the renovations. They don't really limit the type of renovation you can do. Obviously, everything has to be permitted and plans and everything. But the main catch is here that the cost of the actual renovations, here is where they control what you do. The cost of the renovations cannot exceed 75% of the as completed value of the property. That's the key, right? So if, for example, your as completed value of the property is $400,000, you cannot have renovations that exceed $300,000. That would be quite a project, right? And something also to note here is any type of green renovations, something where you have a green component, right? Helping the environment, making the property more energy efficient, making it more water usage efficient. There are credit fees in the form of rebates and reduction to the like percentage discounts to the loan, right? So keep that in mind. If you do have a project and it does have green components, you will get some additional spiffs there. Not very big, but every little bit helps when you're embarking on the mission. So keep in mind, remember, now real important here to note, if your borrower is looking to add an ADU, you have to go with the Freddie Mac option. Now here, this is our Fannie Mae HomeStyle, right? Fannie Mae's renovation product is the HomeStyle, whereas Freddie Mac's is the Choice program. Now here in our example, we have an 80% rate and term refinance. Cash outs are not allowed. Now, very important to note here, my first bullet point there, right? Contrary to what I just said for Freddie Mac, for Fannie Mae, additions of attached units or ADUs are considered reconstruction and ineligible under the HomeStyle renovation program. So if your borrower, again, is looking for the ADU, you got to look for Freddie Mac and not Fannie Mae. In our example here, we have our borrower using this renovation loan to obviously refinance the existing debt and also remodel the kitchen, both bathrooms, add on a fourth bedroom. You can do all these kinds of things. They're also including 6 months of PITI in the loan. And they've also ensured, again, there's a catch on this one, that the finance renovations do not exceed 75% of the as completed appraised value. And here you're looking at 8.125 as your lowest rate, lowest cost option, and 7.875 lowest rate option. So this is our Fannie Mae HomeStyle, maxing it out at 80%. Our HomeStyle. Our next option here is a pretty cool option. We have a standard FHA 203K. Now, the 203K, like we mentioned yesterday, is possible to do a standard option or to do the streamlined option, right? The streamlined option does limit the renovations max to $35,000, and keep in mind that $35,000 has to include any contingency reserves there. So it is a restrictive program, but the main benefit of the streamlined program is that it does not require you to use a HUD consultant. So you're going to save $750 to $1,000 there. Plus, you're also not going to have the HUD consultant going with their clipboard throughout the property, notating extra things that may need to be done that you had not budgeted for, which unfortunately will increase the cost of your project. And if you are still wanting to do that streamlined project to keeping it at 35, or if you're only budgeted, let's say, for a certain amount, let's say you're only budgeted for $40,000, that's all you can afford. You get the HUD consultant going in there, and all of a sudden finds all these things wrong with the property that HUD considers it, livability or habitability components that need to be taken care of, or else they won't let you close on the loan. You may be looking at an extra $10 or $15 or $20,000, and if you only qualified for that loan amount, now you got to redo your project. Now you may not be able to do the same quality that you wanted to do, the same items. Maybe now you can't redo the new windows. Maybe you can't do the new flooring or the fancy whatever. It's just would not be a good situation to have that happen. So keep that in mind. HUD consultants is required on the standard program, not required on the streamline program. In this scenario here, our borrower, right, is purchasing a 2-unit property that also has an ADU, right? This is the ultimate house hack, primary residence. So he's going to have the 2 rental units there. But here's the cool thing about this project, right? Our borrower is getting the 2-1 and 2-1 and ADU, and it's making it a 3-2 and a 3-2. You're able to do that on the standard program. So what's really cool about that is that when this goes through the appraisal, and you're going to have a 1007 here for the market rent. Well, I don't think they're going to call it a 1007 if it's a duplex. I believe it's a 216, which is an operating and income statement. You're going to get the rent of a 3-bedroom, 2-bath on that additional unit to help you qualify versus a 2-bedroom, 1-bath. So yes, you do have a little bit more of an expensive project, right? You have a little bit more to qualify, but you're getting higher rent from that additional unit for qualification purposes, which should help offset that extra expense. And then our borrower also is going to be able to renovate the existing ADU. Now, FHA will not allow you to construct a new ADU, but they do allow you to renovate the existing ADU. And in our scenario here, FHA does allow the property to be uninhabitable during the renovation portion of the transaction. So our borrower is going to include 6 months of PITI, and 6 months is the maximum construction time that they give you. If you have to go beyond the 6 months for whatever reason, you have to, ask for the exception and provide documentation as to why you need the extra time. But the 6 months of PITI is included in the new loan amount. So our newly minted homeowner slash house hacker has put together a great deal here. He had a great realtor that found this opportunity for him, and between the two of them and the loan officer, they made that dream a reality. So again, make sure you work with some great consultants. And the rates are pretty good because you're looking at 7.625 has a little bit of a lender credit, and you can buy it down all the way to 6.5%. So you do see that FHA rates for this program and the cost on the rates is better than the Fannie or Freddie options. However, as I mentioned, the Fannie or Freddie the Freddie option lets you construct an ADU where you previously did not have one. So that's obviously a very important point to consider. So now we go to our USDA options. So in case those of you that may not remember, USDA loans do allow closing on properties that are in rural areas. USDA loans, in order for a property to qualify for a USDA loan, it has the address, its physical location has to fall within an area that is approved by USDA, right? So it's basically has to be rural areas, because USDA, the mission of USDA is to promote home ownership in our agricultural communities, especially for our agricultural workers, the people that feed us, right? We want to be able to eat. So it tends to, those communities have a little bit lower income than our more urban communities. So hence, USDA was created for that, and also for the fact that other loan types may have an issue with some of the characteristics of USDA properties, be it a larger land to structure ratio, which may not work for some loan types, especially when you're looking at the value of the land to the structure, and also distance between the comparables may be an issue, which would not be an issue for USDA due to the nature of being a rural property. And then just the fact that it's going to be labeled as a rural property due to its proximity to services, right? So all of these things is what USDA is meant to solve. Hence, USDA is more restrictive in the unit count. USDA, this product is only available for a 1 unit property, right? But USDA does allow the property to be not habitable during the renovation. Hence, you can include up to 6 months PITI in the new loan, right? While you're not living there, and you got to be possibly, unless you're living with your parents or somewhere else, right? You're going to have to pay rent somewhere else, so that you don't have to be paying double rent. That's the purpose of letting you include up to 6 months PITI in the new loan. And in our example here, our borrower, now USDA does have 2 options. They have like a standard option, and they have a limited option. For the limited option, they do not allow you to do any structural type repairs. For the standard option, they do. So our borrower is definitely trying to maximize his scenario here, going with the standard option. They found that little house that they love, and they're adding a master bedroom and bathroom to it. They're renovating the kitchen, including the appliances. That's the only personal property that you're allowed to include. Renovating the existing bathroom, installing a new roof, and this house even had a pool, which they're resurfacing the pool and taking care of a new pool pump. Now you cannot in USDA you cannot add a new pool because USDA is really not about luxury items. So if some of the things that you're going to do in the home is too luxury for them, I guess I don't know what they consider, gold plated fixtures, maybe something like that. They're not going to let you do it, right? They don't want you to squander their resources on luxury items because they have a lot of people to help. That's the purpose of USDA. So here we're looking at really good rates here, right? 7.25 is our lowest cost option, and 6.625 is our lowest rate option. And this is a 100% LTV purchase, just like VA. And in this example, like the others, we're using a 740 credit score. And our last option, last but not least, is another hack, right? Our VA renovation purchase of a 2-unit property, also known as a duplex. Now, VA is the one option that requires the property to be habitable. The maximum number of days that they will allow for the property to be not habitable is 15. That's 15 days. The borrower needs to be living in the property during the repairs. That could be a little uncomfortable, gets a little messy when those contractors are there, especially in this case, because you're going to have to be doing some eating out here, right? Because, we're in our duplex, we're going to be putting a new roof. So you're going to have to do it in phases. You just can't do it everything at once and then not be able to live there. You have to figure it out. But we're putting the new roof on there. We're renovating both kitchens, all the bathrooms, and we're even putting in a new water system. This home is on a well and pump, so we're going to put a new pump, filters, all that. But all of that is done pretty quickly. This is not, and again, you're not going to do it all in one shot, because if you have them come in and disassemble everything in one shot, you're not going to be able to live there, right? So keep that in mind. And plus, you're going to have to do some explaining, probably as part of this loan, probably some documenting by the contractor of the action plan that they're going to follow, and real clear to underwriting, so that you can convince them that you're going to be living there during the project, and that you're not going to have longer than a 15-day unhabitability period for the property. That's probably going to be one of the biggest challenges. But in this case, our buyer is another house hacker with that 2-unit property, the duplex. And in the end, they're going to be way better off, and much better than having to charge up their credit cards at 28 to 30% interest, or whatever credit cards are charging nowadays.
All right. Looks like we do have a question here. If you want to pull up that question, Nick, and anybody else, feel free to drop a question before we get out of here. The question is, how do they verify contractor experience, Jose?
Well, that's a good question, because in a renovation loan, you have basically 3 major components of the loan. You have the credit and income underwriting, right? You have the project underwriting, which is going to include determining the as-is value, the renovations, and the after-repaired value. All of that comes into play, right? And then you have the contractor vetting, right? They're going to really vet that contractor really, really deeply, because they don't want the contractor taking off with the money. So there's, the contractor is going to have to provide resume, references, track record of properties that they've completed, They're going to have to provide their insurance. They have to have a liability insurance policy. They have to have workman's comp. They have to have a E&O type policy. So there's, a lot of things. They have to have good credit. They have to have what you call, they have to be able to finance some of the repairs. They have to have their trade accounts, because remember, this is done on a series of draws. So at the onset of the project, there's going to be an initial draw at closing paid out, but not the full amount. So some of the things, the contractor is going to have to wait to get paid on, and they're not really going to accept that the contractor asks the borrower, okay, well, I need more money. You got to give it to me now, and then you wait to get reimbursed. No, the contractor is going to have to understand how this renovation loan works. It works like any other construction loan, right? So it's going to have to be a solid contractor that is able to work with these products. And also, one of the things, a contractor is going to have to collaborate well with the borrower to provide not just their own personal documentation, but the repair estimate for the property, right? Because it's going to be on certain forms. They're really going to have to break it down very detailed. So like I was mentioning yesterday, they're not going to be able to provide the estimate on a napkin, so to speak. 5-line estimate. Here you go. Pay me 50% up front and then let's start. It's not going to be anything like that. It's going to have to be a real professional contractor. So sometimes, and I think Kyle will attest to this, the contractor part is the most difficult part to get in line of this type of transaction. That's really the one that you have to look at.
Yeah, absolutely. I did one of these maybe 11 years ago or something. And as Jose said, the contractor has to have all these things in place. And even when I got a contractor that had all these things in place, the proper bonds, insurance, did the estimate, all this kind of stuff, I still got left hanging. And they really, messed me up, and they left it uncompleted, and they tried to charge for things they didn't do. So I really had a bad experience. So, it's definitely really all about getting a good contractor. And not only do they have to be in good standing with everything and have the right licenses and bonds and insurance and everything, even the ones that have that can still leave you hanging. And my project was kind of a testament to that. Let's see here. Another question. Did they say the contingency percentage?
Yes, contingency percentages can depend on the scope of the work, can be, and also on the different loan type, whether it's conventional, FHA, USD, ABA. It's going to be anywhere from 10 to 15%. And if there's anything left over at the end of the contingency, it just gets used for principal amortization. They don't give it back to the borrower in a lump sum distribution. They just put it back into the loan to pay down the balance.
That's a good point too. There's 2 names on every check, right? The borrower and the contractor. You guys have to work together nicely the whole time, right? So it's definitely the most challenging part of the deal.
Yeah, absolutely. I mean, I had to sign off on every check, and at the end of the process, they actually left me hanging. And so the mortgage company actually, sided with me, and I didn't have to pay them out those remaining checks for the work that they didn't actually do. And that's because they don't just send a check to the contractor and say, here's your money. They send the check to you, and you have to sign it and work with the contractor. So unique process.
The one thing on the contractor, since I see we have had a few contractor questions and comments, is I'll just restate some points from last night. You need to use a contractor. They do not allow self-help where the borrower is doing. So no sweat equity here is going to be involved. You cannot have any relation to the contractor at all, right? They don't want there to be any kind of conflicts like that. And you can only use one contractor. There has to be one responsible party only. Now that contractor, obviously being a contractor, they're going to sub out all the work to the subcontractor. That doesn't mean that one contractor has to physically, do all the work per se. It just means that they need one accountable, responsible party. That's the one they're going to vet, and that's the one that's going to be on the checks along with the borrower. So you're not going to be allowed to have multiple contractors. And some people, sometimes that's what they would like to do, because then they would like to be able to subcontract the people themselves, try to save a little money, try to, stretch out the dollars from the renovation loan. But that's what the lenders don't want, is for something like that, because in essence there, the borrower is acting like a general contractor. They have experience in the past, that can cause issues. So they want one responsible party only, and that, obviously who's going to have that liability and the errors and omissions insurance in case anything happens. There, that's where the buck is going to stop.
All right. Well, great topic there. Great scenarios. I love those real, life scenarios. Gives us an idea of what we could actually be using these for. So if you want more help navigating, of course, themortgagecalculator.com, you can visit us there. All the loan officers out there, remember, if you didn't catch yesterday's training, you can do so on our YouTube channel as well, where we kind of introduce the topic for today. But thank you, everybody, for tuning in. We appreciate it. Thank you, Nick. Thank you, Jose, for the great examples. And we hope to see everyone next Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series, where we'll do a different topic of training here. So thank you, everybody, and we'll see you next week. Have a great night.
Thanks, everybody.
Thank you, everybody.